Good afternoon, gentlemen.
Hello
Howdy.
there.
Welcome to the quarterly webinar, and really excited to talk through a lot of various topics today. But I want to give everyone a few minutes to just get on, make sure the sound is right, and that participants are able to hear us and join us before we jump right in. So, really appreciate you joining, Skylar and Greg. Ready for another fun 2026, a new year, and lots to do.
Now, do you want to anger any Pittsburgh fans that are listening to us right now? Let's do that for a minute.
That's great. That's great. That was a great win by those Texans last night. Um,
Oh, yes.
Mike Tomlin, what a coach, but the man can't win the playoffs for some reason now.
No, he can't. And Aaron Rodgers is looking as old as I am. I think he might only have 1 year on me. But when you compare him to a bunch of 23-year-olds, he looks ancient.
That's right.
So, and I did see a clip. I didn't listen to it, but Big Ben weighed in about something. I don't know what Roethlisberger is talking about, but um, you know, there was something relevant for him to get a soundbite. So, you know,
Yep. Long live the Ravens Steelers rivalry. Hopefully, some exciting changes come our way for as Baltimore fans with a new coach. But yeah,
right.
this was an interesting NFL season, that's for sure.
Yes, yes, it was. Yes. It'll be interesting
All
getting
right,
a whole
so
new coaching staff.
that's right. I got confirmation that Jenna can hear and all of the audio checks good, visual checks good. So, want to go ahead get started. So, welcome everyone to this quarter's webinar. My name is Navarone Simpson, and I'm one of the advisors here at Armstrong Dixon. So happy you're able to join us today, and I'm looking forward to diving into several topics on today's webinar. We want to remind you that we welcome live feedback and questions during the webinar. At any time, feel free to email Jenna in our office at jsharman@armstrongdixon.com. She'll be monitoring the emails throughout the webinar, and we'll try to answer everything that comes in. If you have any connectivity issues at any time, we recommend fully exiting and re-entering the webinar. On today's panel, joining me, we have Greg Armstrong and Skylar Engelhardt. All of us in the call today have obtained their certified financial planner designation and have a real passion for helping you and your families. So with that being said, I want to jump into the content. Skylar, I wanted to start with you and hear about the hottest topics for the year heading into 2026, starting with investments and returns for you.
Yeah, so we can take a look right here, and I can pull up our asset quilt. And we have the complete data for 2025 that came through, and our top performer, it was the emerging markets equity, which finished out over 34% return. And just behind that was developed markets equity, which we haven't seen developed markets outperform US markets since 2022, where they had, well, actually, it looks like they were beaten out in 2022 as well, or that's emerging. The developed, it was, you know, nobody was winning in 2022. So even though international outperformed US, everybody was losing. So wasn't a really good feel good moment there, but the United States makes up about 65% of the global stock market. So a 35% weighting to everything internationally is very meaningful. And we try and keep to a market capitalization weighting in our portfolios. And so we weren't sleeping on international last year, but we were lying in wait, and it had worked out for us. And you see S&P 500 finished on a very positive note last year as well. Commodities up, small cap was up, high yield bonds, fixed income, cash, and then everything was positive. There's no real losers. It was real estate was had some modest growth. But as we can see, is having a developed or a diversified portfolio over the years, what it tends to do is it reduces our portfolio risk. So you have a lower amount of portfolio risk as measured by the volatility, and then you can have a level of return that's higher. So your risk-adjusted return would be higher in a diversified portfolio than it might be in a more of a concentrated portfolio.
Mhm.
Yeah, well said, Scholar. And that was a great chart just showing all the different asset classes and how global investing continues to be a way that we like to construct portfolios. It's important that you're not just based in US or just one asset class. You're diversified among many. And one of the interesting things was what happened over the last 5 years with just these various returns in stock, specifically US. So we know the story has been tech, tech, tech. Growth has been the growth stocks have been was driving returns. But then you look back over the last 5 years, and I said, what's the asset class that's actually returned the most in 5 years? And any guesses, gentlemen?
I know the answer, so I'd be cheating.
Well, this graph here, powered through Morningstar, says it's actually been large cap value. So that is somewhat of a surprise to me because that's what we've been hearing is those growth names, the Nvidias, the Amazons of the world, the Taiwan Semiconductors, which are growth-oriented stocks that have gone so well. But when you look at it in aggregate over the last 5 years, which includes the 2022 year that Scott was talking about, value has actually outperformed growth.
Mhm. And again, I mean, if you look at growth, like you said, that's what's being talked about the most. And it's good to look back at these numbers because this just gives you multiple reasons for that diversification that you mentioned before. Is don't chase what was good last year. Try to have Skylar, you mentioned the global equity of international versus domestic, and trying to match that and not going away from what that global capitalization is, because there's a reason that US is 65% right now ish. So we want our portfolios to be that way. Even though international almost doubled what the domestic equity markets did last year. So the rebalance aspect, when you have a portion of your portfolio that was riding high, that's part of our strategy, and also what we do for our clients' portfolios is look at any outliers and then we rebalance to the original allocation. So I'm sure everyone listening to this has heard us say that, but we can't say it too many times. It's
Yeah, and I'll tell you what Nav was talking about, how value was a driver of performance, the value factor driving performance over the last 5 years. Here is a look at quarter three 2025, uh, quarter three 2025 from 2024, and this is not the performance of the company, but this is earnings growth, uh, which is accretive to investment performance. But with the earnings growth that we're seeing is like, yes, tech did have earnings growth. It had the most earnings growth, which is, and it's a growth style of company. But then if we look at the next area, the next sectors where we saw a lot of earnings growth, these are all value oriented companies.
Mhm.
And then if we look at performance, you can see, hey, growth was a big factor in tech, but everywhere else we're seeing performance coming from value companies as well, in different other sectors. And then also interesting is looking at what sort of the valuations are in terms of the price that you pay for a stock based on what their earnings are, is like, hey, value is still a value relative to growth current day, but if you look at growth trading as a higher multiple historically, both value and growth are trading at higher multiples than they have historically. So value is not as valuable technically because you're not able to get in as low, but everything is trending higher, and this has to do with the higher asset prices.
Right.
Great charts, guy. And the within that tech sector, we know what's driving a lot of the growth is alternative artificial intelligence, right? The investment that's going in it, the ability to get more productive with less. But when we look at what's actually driving that, it's investment within the hyperscalers, as they call it. That's the Alphabets, the Amazon, Meta, Microsoft, Oracle. Those are your big tech companies that are really spending on data centers, spending on infrastructure in order to build out this AI suite that's being used. And because of that, on this far right hand side, it's showing operating cash flow of these companies is blue. You can see that operating cash flow is high. It's growing likely because of the investments they've been making, but the capital expenditures are also growing quite a bit. That means they're investing within not only this country, but all around the globe. And what that does is that increases the flow of capital throughout the US and the economy, helps with earnings for individuals, spending power. All that is important. And then at some point, things are going to continue expanding, and more companies are going to be using these technologies to then trickle into their businesses to help their own bottom lines. Any thoughts on this chart? I mean, the spending is pretty staggering. These are in billions, and 500, 241 billion, 400 billion, estimated to be up 5 to 600. It's a lot of money that's flowing into these hyperscalers.
And what kinds of companies and like or which industries are we seeing this investment, or like who's using AI and to what extent, kind of?
Yeah, great question. And this chart breaks it down with from the implementation standpoint. At the end of December 2025, we see which sectors and companies are using AI and how much more they plan to use them within the business. So the
Hmm.
two highest, information, professional, and technical, 32% each. And then right underneath it, our industry, finance, insurance, companies like that are investing heavily into AI and using them to make their processes more efficient. But that's all across the board. You'll see investment and use of AI is going up and will continue to.
Yeah, it's going to be interesting how each sector enhances their normal way of doing business with AI. It's going to continue to evolve. I'm the way that I think about at least our industry is how do we use the word efficient, Nav, and how do we use the software and the technology out there to enhance what we're doing with you who's listening, our clients, within the team itself. So we're going to continue to look at the different softwares available. You've seen it on our meetings. Where the note taker, so it allows us to engage a little bit more during the meeting and not be furiously taking notes. We're going to continue to use it with our rebalancing and our portfolio construction, some of our analysis, etc. So you're going to be seeing more and more just from the Armstrong Dixon and then the overall financial sector more and more as we're embracing this fast modification of how we've been doing business for years. So it's gonna be exciting to watch, and I really do like this chart because it does break down the significance by sector that AI is a part of their businesses so far. So this will be a good chart to watch, as the years tick by.
So what do we got on the docket then for 2026 in terms of what's happening in the markets since we looked at 2025 and what's been happening last year. This year, I think the bull run may continue, and we're probably going to see some significant volatility along the way. Um, you know, Venezuela has been in the news, Greenland, just locally here. Now, Iran is having some protests that are going on in their government over there. So I think that there's going to be continued geopolitical risk that's going to impact markets. But as we see, if we see any pullbacks, I think there are going to be more opportunities to increase the equity share than it is going to be as a reason to stay away.
Yeah, and it's just a continued importance to plan out when you would plan on using a block of your investable assets, I'll call it, because with this geopolitical risk and this potential higher than normal volatility, we want to be sure that if you're planning on making a purchase or paying off a debt or significantly changing your financial situation, that we plan that out and we use the higher markets that we're seeing right now to raise the cash to prepare for whatever that expense increase or debt payoff, whatever that you're contemplating. Now's a good time to raise some cash knowing that the markets are high. The CPI numbers came out earlier today. They were a little bit better than expected, but relatively, equal to what they were predicting, the analysts were predicting. So we're going to continue to have headlines. We always have headlines. And our job is to try to see through it, make sure that with your individual situation that we're tweaking, modifying, adjusting as necessary. So just keep us in the know for when things may potentially change in all of your situations.
Yeah, very well said, Greg. And that's the practical part of all that's going on, right? It's personal, specific to each and every family, each and every client. So definitely reach out with questions as things come up. I wanted to shift gears a little bit and go to some updates for 2026 with tax season right around the corner. Um, Greg, would you mind leading us into that discussion?
Sure. And if you wanted to have a conversation with your CPA, now's the time to do it because they're gonna go AWOL soon. Maybe not AWOL. Maybe they just locked themselves in their office. I know my father was a CPA, and I don't think I really saw him for the whole month of February, March, and a little part of April. And then he reappeared on April 16th. I'm like, oh yeah, hey, how are you? So if you have any questions, get those to the CPAs now. Let us know. Maybe we can help you, or we can reach out to the CPA alongside of you. But now's the time with questions because as we get closer to the corporate and then the personal deadlines, they're going to be a little bit more scarce. So what we have is we have some partners that provide us these summaries of all of the different uh, how the numbers change. So on this left side, I was just going to walk through a little bit. This is, I'm sure, very, your eyes are going kind of crazy right now, twitching with all of these numbers. I'll try to summarize a little bit. These tax brackets on the left-hand side, they generally speaking, they were increased. The limits right here were increased by about anywhere from like 2.2% to about 3.9%. The tax bracket stayed the same from a percentage standpoint. So you can see how if you're married, filing jointly, single, married, filing separately. So they increased a little bit, but I did want to point out here when estates and trusts are involved in your individual planning, there are condensed tax tables here. So we need to be cognitive if a trust is in a taxable income scenario. But these also increased a little bit, anywhere from the 2 to 4%. The standard deduction here that is up to 32,200 for the married filing jointly. So this is up slightly from last year. These new deductions, so this is part of the newer legislation that we're working with now. Um, some of this applies, some doesn't, or some do and some don't. But just some highlights are on here. Bonus deduction for anyone 65 or older. It's a 6,000 for single and 12,000 for joint filers. So that is new, increased. The state and local income, so the SALT deduction was $10,000 and now it's 40,000. So that is a major change. If you have a business and you're paying state taxes through the business, that was a strategy that really helped you in recent. That might not be necessary depending on what your taxable income is now that the limit is much higher. If you're in the service industry, tips and overtime pay, there's deductions for that. Interest on American-made cars, that is a very complex and tons of variable to actually qualify for that. So if you want to buy a car, get what you want. Don't buy it because it was because of this little tiny deduction. Um,
And don't forget about it though if you did buy a car, because Toyotas, for example, have cars that are finished in specifically in their San Antonio facility. And even though it's a Toyota, people think, oh, that's a Japanese, it's a foreign car. It was finished in the United States, so then it still would qualify for that deduction. And I would also expect to see folks that maybe were using the standard deduction before may end up itemizing this year because of that increase of that SALT deduction.
right. Yes. Yeah, and that involves the charitable aspect as well. From do you itemize or do you take the standard deduction? So it's definitely a conversation that needs to be had to try to plan out what you would potentially do in 2026 into 2027. Obviously, that can wait a little while as we just started 2026. The estate tax exemption went up about another $1 million. So each person can pass $15 million. That's what the unified credit amount is. It was up from 13.99 million last year. Annual gift tax exclusion, that stayed the same. That's still at 19. So that is when you're gifting money to kids, grandkids. It can be involved in the 529 contribution amount, but that 40% stayed the same. So anything over and above this estate tax exemption, the IRS is going to apply a 40% tax on that estate. The 529 funding, there's the 19,000. It hasn't changed. There's a little bit, let's see my notes over here. So the kiddie tax threshold dropped in half. There's a slight increase for the student loan interest deduction and the tax-free savings bonds. That's all described in here. On the retirement side, so your IRA, so Roth IRA, traditional IRAs, that limit went from 7,000 to 7,500 if you are under the age of 50. And then if you're over 50, the amount went to 8,600. So there's slight increases there. The phase out for deducting IRA contributions, these increase a small amount. So if you're right on the cusp of whether to deduct an IRA contribution or want to contribute to a Roth, we have to relook at your AGI projections with these new amounts. And then down the bottom, these are some of the employer designed retirement plans. So the SEP contribution went to 72,000. Simple went up to 17. So long story short, we had slight increases on the tax tables, thresholds, and then some of the retirement contributions. So if you're on automatic deductions for your retirement plans, let's look at them and potentially adjust them up a tiny bit to make sure you're hitting the max with these new limits that have come about.
Yeah, and they're all good changes. That's one of the biggest benefits of what's happened is they're all favorable for most people. So higher SALT deduction. If you live in a state with state income tax, you have a mortgage interest, and you have charitable gifting, you can now take a much bigger advantage of all of those things on your tax return. And you might actually be above that standard deduction limit now where you weren't before. Same thing with the 401k contribution going up, the IRA contribution going up. This is all ways to either save taxes now if you're doing traditional, or save tax in the future by adding more to Roth assets, tax-free assets that can now grow into the future. So it'll be a very interesting season in 2026 in terms of what happens with the filings, how what refunds look like. I know the administration keeps talking about this. They're likely expecting bigger ones. One of the reasons is that's senior deduction that's now expanded to 6,000 to 12,000, depending on single or married. That'll have a nice impact. And that's kind of how they use and talks about the Social Security is like, well, using that will likely help reduce Social Security taxes. So a lot of different things going on. Definitely talk with the CPA, your CPA and tax professional, just to make sure that you're taking advantage of what's available to you. We're here for the tax planning side also. So, any other thoughts on the tax side from what Greg was sharing, Scott?
Yeah, I didn't see it on there, but I think for non-itemizers, making cash gifts to charity, there's up to $1,000 of deduction that you can get whether you itemize or not, which is nice. And then tax forms from LPL are going to start to be mailed January 31st. It's going to roll out with 1099-R forms are going to come out first, and then there's going to be phases on February 15th, February 28th, and into March 15th as well. Depending on the underlying investment assets, some of them recharacterize the different types of distributions, and so it doesn't show as much income, but you have to wait a little bit for the forms. But if you have an IRA and you're taking distributions from that, the 1099-R forms will be coming out here at the end of the month.
Yeah, and they're always accessible on account view. So if you have it set up and you are familiar with that, you can go see if the 1099 is available. You can send us an email. We can check to see if they're available. And the easiest way for us to get them to you, if you want to forward to the CPA, we could use the share file in our email that we can send you, or we can upload it to your vault within Wealth Vision. That's the securest way to get the 1099s to you. If we need to send it directly to your CPA, we'll need an authorization form completed so we can send it direct to them. So, so be on the lookout, check account view when these 1099s are available, and well, they'll be out as soon as they can be out. So unfortunately, we don't have a whole lot of control over the timing of that, knowing that it does get frustrating every single year as we wait and wait and wait and wait and try to be patient.
That's exactly right. Yeah, and there is a feature now where in account view, clients can actually give access, CPA access directly to it. It's a limited access, and they can only see those tax forms. But that is a new feature that is available to clients through account view.
Nice, nice. Thanks for mentioning that.
Absolutely. So taxes, a lot's going on there, a lot of different updates, but feel free to reach out with questions. We're here to help. Some new things that I just wanted to touch on would be some business updates, and just honestly, just be thankful and thank you as our clients and everyone at the firm for all the hard work that was put in for 2025. It was our best year yet, and we're very excited for what's coming in 2026, which includes just a more deeper roles for our all of the employees. Want to really shout out to some of our newest hires, Julie, and then Tucker, Kristen, and Jenna. All have really come in to really expand the role, the way we deliver information to you as clients, the way we're able to work from both the front end and the back end has been instrumental. Tucker is a servicing advisor that works along the same role as Skylar and myself, partnering up with Joe and Greg to really deliver high levels of uh, information to the clients, make sure that it's um, personable. Kristen on the operations side, doing a fantastic job of working with paperwork, communicating with clients, making sure that things are professional and look good on the back end, and has really helped us in that role. Jenna, being I know a lot of you have heard from her. She's been helping us schedule meetings. She's been handling a lot of the marketing and letting those newsletters. Her and Julie in tandem, really working great, and really excited for what's coming for Armstrong Dixon with all these great people that we work with and get to share our each and every workday with.
Yeah, I'm actually very excited. We have our the annual report for 2025 is going to be coming out. Or I don't know if it's the 2026 annual report or the 2025.
2025 delivered in 2026.
Yeah, yeah. So
Correct.
we had an annual report that had come out last year, which was I really enjoyed it, and we have another one that's coming out this year as well. I'm excited to see sort of the final draft that should be available to us to see in the next day or so. We'll be having those out to everyone shortly thereafter.
Yeah, and what I'm most excited about, the strength that Julie, Kristen, and Jenna are bringing on the operation side. It allows the three of us, Tucker and also Joe, that aren't with us today, to have more time to concentrate on our clients. I know that is buttering you all up a little bit, that comment, but it really, that's what our unique ability is being with you all, making sure that we have multiple people looking at different angles of how we tackle the different decisions that are facing, that you all are facing day in and day out. So that was our major goal that we had, heading into even 2024 when we were looking to help Katie out with the hire of Julie. And then we were able to find Tucker at the end of 2024 and then bringing on Kristen and Jenna full time 2025. So we feel that our team is built out to allow for continued growth that we've experienced over pretty much every year. We've experienced growth, but we have the capacity now to really kick that into gear. So definitely excited for all of our new team members. And if you haven't heard, met, or spoken to any of those new folks, when you have a spare minute, which I doubt you do. I know I don't have any spare minutes, but give them a call, ask them how they're doing. I'm sure they'll be
Yeah.
happy to talk to you.
Even if you don't have a need for like to update something on your account, you might anyway, just so you can get connected with Kristen and have the full experience because she is awesome. And also in 2026, you can expect that we're going to be having our website is going to be rebranded or we're having a new website rather with enhanced features and resources.
Yeah.
And there's going to be also new content on our blog, Facebook, YouTube, LinkedIn, and Instagram. So if you're not already, please follow us there.
Yep, and that is a lot of great things that are coming your way in 2026, and that also does include a replay of this webinar that we have, so that you can go back, watch it, share it with friends and family who might be interested in learning more about finances, taxes, everything going on. So that will be coming as well later this month. And as Skylar mentioned, that annual newsletter that we're all excited to see. Um, and the website would be by the end of the first quarter is what we're aiming for. That you might see that new look, and there'll be a client resource section dedicated to clients to help answer questions. So we're very excited about that new feature that will be coming by the end of first quarter.
Busy, busy.
That's right. So we will be having a guest speaker join us here, likely in the next 5 minutes or so. Her name is Amy Udemy. We've been working with her for quite a long time, and here she is actually popping on right where your ears ringing. Amy, how you doing?
Well, thanks. How are you?
We're doing great. I was just letting the clients know that hey, you're coming on, and I'll let Greg do a nice introduction for you. But I really appreciate you taking the time to join us today.
Of course. Thanks for having me.
Yeah, you have a little bit more peaceful background than we do, Amy. Something about the water, now what bridge is that? Is
It's
that
the
the
Bay Bridge. No, I
okay,
know people ask all the time. They're like, "Is that bridge still there?" I'm like, "It's
okay.
the Bay Bridge."
Right. It doesn't look that pretty blue
No,
when you're driving over it. But
does not.
thank you for joining us.
Of
And
course.
from an introduction standpoint, my career started in 2024, 2004. I guess I'm getting old because I made that slip up. But I feel like I probably met you, Amy, quickly after I started. Definitely when I joined Lincoln in 2005. I know that we've been working with you. So for everyone listening, they are one of our strategic partners that there's no affiliation with ARPS, which is Amy's company, with any of our companies. We truly want to partner with them. It was our decision to partner with them to be one of our resources when we're looking at retirement plan work for our clients. They have a way of bringing the terminology to English, which is very important when you're living in the world, Amy, that you live in. It's important to have good communication, and I really have truly enjoyed the 20 plus years experience working with you guys and the various clients that we share. So thank you for your time. We had a couple of questions that we thought we would pose to you just to outline a little bit about what you do, provide any tidbits or nuggets that you have to our audience. So again, thanks for coming.
Of course.
Um, and why don't we start with what is a third party administrator and what do they actually do? So you got to live up to my comment of bringing it to English. So please translate what a third party administrator does.
Sure. Thank you. So just to kind of break it down in English, as you say, we're effectively responsible for what I would say is the legal, accounting, and compliance work associated with retirement plans. So if you've never been a business owner or you've never sponsored a retirement plan, you might not even realize that this goes on behind the scenes. But, if you've just been a participant, you might not have had any real interaction with somebody like myself. But any retirement plan that is in place that's a qualified plan, like a 401k, a 403b, or even just a straight profit sharing plan, likely has somebody like me behind the scenes. So when I say the legal side of things, we work with the plan sponsor on the legal document that dictates things like when somebody becomes eligible, what kinds of contributions go into the plan, when you can take money out of the plan. And that's something that we work closely with plan sponsors on to make sure it matches their goals. And it's not necessarily a set it and forget it. We receive major legislative changes from the government that we have to incorporate into those documents and work through with our clients as well. On the accounting side of things, we look at auditing to make sure that when a contribution was withheld from someone's pay, that it actually ended up where it was supposed to be in the right place. So, if you have a 401k salary deferral coming out of your paycheck, you want to make sure that it went into your account and not your coworkers, or that it went into, as a pre-tax contribution instead of a Roth contribution. So those are the types of things that we look at in terms of making sure that our clients' plans are operating correctly. We record keep for those plan assets as well. And then on the compliance side, which is I think the piece that most people are very unfamiliar with, is that there are many tests that are required from discrimination to coverage, um, just to make sure that we're following in line with what the IRS and the DOL say is okay for offering these types of tax qualified plans, including a special government reporting form that's like a tax filing for the plan itself that we prepare for our clients as well. So everything from operational to compliance to reporting is what we handle for all types of retirement plans.
Well, thanks, Amy. And I wanted to just give a couple of examples of how you've been able to help us in working with the client. If we just started working with a new client and they have a SEP, a simple, a 401k, and they're contributing to multiple plans just because they thought they could or didn't know that they didn't know the full rules. So working with you to understand what has happened in the years past and either correcting or figuring out a solution moving forward based on having multiple plans, multiple employers, businesses, etc. Sometimes there's multiple businesses and they decide not to include that business that has 100 employees and
Right.
only the business that has one employee to try to maximize. So we, try to deliver the news in a very um, uh, an easy ways to fix what they were doing or what they weren't doing. So that has been a huge help to us to make sure that the client gets in compliance or remains in compliance with how complex some of those situations are. So that's been a huge help that we've used you guys in the past.
Thank you. I mean, so I think that's something that really kind of is a differentiator in terms of working with a firm like mine, as opposed to maybe if you have a payroll company that's doing administration, or if you have an investment platform that's doing administration. They're certainly able to do some of the kind of very high level functions of what we do. But when you are dealing with corrections or controlled group situations like you're talking about, or multiple employer plans, things like that. I think that's really where you're not necessarily going to get the same type of consulting or expertise, or even just the follow-up questions that are needed to determine that there might be an issue in the first place.
Yeah.
Right. Yeah, thank you so much for that explanation. And just looking forward now into 2026, I wanted to ask, what are the main changes to the retirement plan landscape for this year? I know there's some changes with Roth catch-up requirements and super catch-up abilities. So any insight that you can give us there and our clients would be
Sure. So we've had some, I mean, I've been doing this for this January is my 26th year in this business, and we certainly get law changes from time to time that need to be incorporated. But within, I want to say, the past 3 years, the sheer number of, or maybe even 4 years, the sheer number of law changes that have come through in regards to retirement plans have been really, I would say, overwhelming. Some of your clients may have heard of things like the Secure Act or Secure 2.0, which is the second version. I think they're already working on Secure 3.0. So there's been a ton that has occurred over the past couple of years. I think you mentioned the Roth catch up and the super catch up. Those are certainly some of the more impactful changes, especially for those people that are 50 or above. So the Roth catch-up contribution is something that got kicked down the road a little bit, in terms of the fact that it was originally supposed to be effective in 24, and none of the payroll providers or investment companies or clients could get their arms around what exactly they were supposed to be doing and how to make it functional. So they did delay it, but January 1, 2026 was the eventual effective date, which effectively said that if you are somebody who is 50 or above and you earned at least $150,000 last year, so in 2025 you earned 150,000 over $150,000 in FICA wages. So we're not talking about self-employed people. I don't know if that's a loophole that they intend on fixing, but for right now, it's just FICA wages. So if you had over $150,000 in FICA wages last year, you're 50 or above this year, and you want to be able to contribute that extra, what's referred to as a catch-up contribution in 2026, that piece of it has to be withheld and deposited as a Roth contribution. So I think most people are familiar with pre-tax salary deferrals. That's always, a standard. But most plans, especially now after this law change, have provisions that allow you to have your own pay withheld after taxes, deposited into the Roth bucket. And then as long as you hold it for 5 years and are over 59 and a half when you take it out, it comes out tax free. So if you meet those qualifications, you're 50 or above, you earned over 150 last year, you can still contribute the regular salary deferral limit, 24,500 for 2026, as a pre-tax contribution. That can still go in, withheld like normal and deposited that way. What you do not have a choice about is the additional $8,000 in catch-up contributions. That now has to be withheld and deposited as a Roth contribution. You can do your 24/5 as Roth as well, but you're required to do your catch up as Roth. As far as the super catch up contribution rules are concerned, they have made it so that if you are, so this is different than the Roth catch up. In the respect that it's not income related, it's only age related. So if you are ages 60 to 63, you're allowed to increase your catch up contribution. Instead of just having $8,000 in additional money go in, you can have an additional 11,250 go in. So that's the limit for 26. We don't obviously have future limits at this point, but so if you've turned 60 to 63 this year or in the future, you can do an additional $11,250 in catch up. Of course, if you earn over that 150, that money does still have to be deposited as Roth, but the limit is for everyone in that age range. So the keys to remember are if you're turning 60 in a year, you can do it. If you're turning 64 or older in a year, you're back to the regular catch up limit.
Gotcha.
So everybody
Yeah,
can
and that's just when I brought up all those new numbers, we're on this. So we'll have for our clients, we'll have this on our annual review to just really aid in making sure that when you hit those different ages and if you have the cash flow to make sure that you maximize your contributions.
And sorry, I didn't mean to interrupt. I will say that, for the Roth catch-up contributions, that is a required change. So every plan has to have that available for their participants. The super catch-up is an optional change. So I will also say that because all of these regulations have come through in such quick succession, we didn't even get the language for them until recently, that very end of 2025, and we're not required to amend the document for those provisions until the end of 2026. So I would say if you're not sure, ask your employer or your HR person to look into it, because it might not be reflected in your document or your summary plan description yet. And like I said, it is an optional change. So your plan might be operating that way and you just don't know it.
Yeah. Okay.
Very important point. Because clients might say, well, let me do this catch-up contribution because I'm 60 or 60 between 60 and 63, and they go to put it in, and their system will say, no, you can't do it. That's
Right.
because the plan isn't hasn't adopted it yet. But she said
Right.
by the end of 2026 or 2027, have to do it.
They may choose to do it. The super catch up is optional. So I don't know why they wouldn't. But if it's just maybe one more thing that they have to deal with payroll, maybe they choose not to. But operationally, they're allowed to, even if they haven't amended to do it.
Thank you so much for explaining all that.
Of course.
Scully, you got another question?
I was just thinking, if I, so again, it's if $150,000 if you made it or more as an employee in 2025, now your catch-up contribution has to be Roth. So if you're 50 to 59, or if you're 64 or older, that's an $8,000 amount that you previously had a tax deduction for or could have a tax deduction for, but now it's a non-deductible contribution that you can make. And
Exactly.
then same thing, if you're from 60 to 63, that's $11,250 that could have been a tax deduction last year,
Right?
would not be a tax deduction this year. And so I guess logging on and updating your contributions, if you're contributing to a plan, is going to be a good thing to do. One, you need to make sure that you're maximizing if you can. So 23.5 is now 24.5 in 2026, and it was a $7,500 catch up last year. Now it's an $8,000 catch up. But if you made over 150 from that one employer, right? It's not if you made it from different companies.
So
So
there are some plans that are saying you that are electing to allow that. You can choose to do that. I think it's going to be hard for employers to track that. So generally, we're advising our clients just to have it be from this specific plan, this company, as opposed to any other employer, which would be beneficial for somebody if they're under that $150,000 just from their one employer, so that they can make their own choices about that.
Right.
yeah. Yeah, hard to keep track of all of the money that all of your employees make,
Correct. Right.
you
Right.
know, if they have other income sources.
Right. Or if they worked somewhere else for part of the year, things like that.
Right. So we're running short on time, Amy, but I
Okay.
did want a quick plug about another aspect of how you've really helped us help our clients, and that is the layering of potentially a defined benefit plan on top of the defined contribution. And in English, that is a defined contribution. A lot of the times is 401k. So you have a 401k, you're maxing out deferrals, you have profit sharing potentially if you are the business owner, and if you still have excess cash flow. What we have done in the past is sent you a census of the business, and you go back and you crunch all your numbers and you come up with ideas, plans to potentially layer a defined benefit plan on top of the uh, 401k profit sharing to allow additional deferrals
Yes.
for the companies. And that has been huge for a handful of our clients to get hundreds of thousands of dollars into a tax deferred vehicle in full compliance with DOL, IRS, etc. And then as the companies change, from a census standpoint or adding additional companies, you guys have done a good job of, okay, well, let's plan this. We have this new variable. Let's see how that affects the current plan. And does it still make sense to sponsor both plans?
Yeah.
Absolutely.
So,
So
Yep.
it's if you have the 401k plan and you're 50 years old and you put your 24,500 into your pre-tax account, then you put your $8,000 into your Roth account, and then the company that you own is putting 25% of what your income is as an employer contribution on top of that, and you still have money that you want to save, that's when you set up the cash balance plan and you have further deferral abilities. And I think that those are quite high for deferral, especially the older that you are.
That's accurate. So, if you look at it just from a limit standpoint, let's say in 2026, depending on your age, you can receive a total of anywhere between 72,000 to 83,250, depending on if you're under 50 or in that 60 to 63 range. So, somewhere in that 70, $80,000 range would be where you can max out between your own contributions and the company contributions. And when you layer on top a defined benefit plan, either a traditional, if you're a solo employer, or a cash balance plan, if you have employees, those numbers can go up to, several hundreds of thousands of dollars. The key to those plans are really just that you are looking for a much larger tax deduction than you can get in the traditional 401k profit sharing plan, and that you have an ability to kind of maintain that, high profitability margin, that you're able to somewhat feel comfortable consistently producing at that high level.
Yeah, well said. And if that fits you in terms of being a business owner or interested in something like that, please reach out. We'd happily assess it and see if that fits you best. And then if we can bring Amy on and her team, we will. But really, really appreciate all the time you just gave us, Amy, and all the information. Very valuable. I know
Of
we
course.
appreciate it, and our clients do.
Thank you. Thanks for having me.
Yeah, thank you. So thank you to Amy, Greg. We had a question come in while we were discussing things, and I wanted to just bring it to your attention and ask if you could chime in. So one of our clients reached out, said, I believe we received 7 or 8 letters this past year, including one from Aflac yesterday, stating that their systems had been hacked and our information may have been. What is Armstrong Dixon doing regarding security to protect us as clients?
Yeah, so it's this is here to stay. And the analogy I like to use is, if somebody wants to break into your house, don't leave the front door open. Don't put signs on your door saying that you're vacationing in the Bahamas. And, do whatever you can to deter this from happening. So, from a business standpoint and the actual client data that we have, we go through, our computers are encrypted. We have to go through multi-factor authentication. We've invested in cyber insurance, through our property and casualty carrier. We have strict guidelines from LPL Financial, and then also on our investment advisory side, our attorneys. So we are doing everything that we can to protect your data from many different angles. And then from the personal side, um, it's strong recommendation to look at any of the 3 credit bureaus, get credit monitoring. So a lot of times when these companies like Aflac in this question, they offer 1 year of identity protection. If you don't already have that set up, take them up on the offer. But what you need to do is you need to do your homework on what that actually means, because that is I want to say like kind of like a buzzword or buzz phrase of, hey, this is really all we can do. So here we're doing something, meaning the company is doing something, but you have to understand what they're actually doing, and then finding a way to enhance that as much as you can. Like me personally, I go through Equifax, or I'm sorry, Experian, and I have a credit lock in place. I have credit monitoring. I go in at least once a week to look at all the updates to see if any credit has been applied for under my name. So that's what I'm doing. I have my kids on there as well because they have socials, even though they're minors, but their credit is being monitored. The same with my wife. So from a company standpoint, us, Armstrong Dixon. All those things that I mentioned, we're continuing to do. We work with our technology company. We have uh, webinars and, and, and certifications and continuing ed that we're doing from our technology company to make sure that we can identify phishing emails, etc. So we're going to be calling you all to speak with you in request for a Zoom that we haven't solicited. We're going to call and confirm that was actually you. Because where we mentioned AI before and how it's getting smarter and smarter, we have to be one step ahead. And there is a way to create artificial images, even on through video. So another reason we're trying to get to know you and whether you like Diet Coke or regular Coke. Unless you put that on your Instagram feed, AI is probably not going to know what your preference is, but we will. So don't be shy in telling us what flavor seltzer you like or whatever. This is one way how we get to know you, that we're actually talking to the real client, not the fake one. So
All said,
And
Greg.
hard disk encryption, regular security checks. We have two-factor authentication just to sign on to our devices and also to access every website that we're utilizing. And there is even to like the subcontracting or the providers that are going through, there is due diligence that has been done to vet to make sure that our information is that your information is as safe as it can be. Um, a Social Security administration got hacked. Aflac. I've stayed at a hotel. I intended to stay at a hotel before and didn't actually stay there, but they had our credit card information. They got leaked. Our daughter's information got leaked. Like you said, Greg, this is all here to stay, and you can't be too cautious, basically.
yep, yep. We
Yeah.
appreciate the question
Yep.
and happy to go into it more. If you let us know, we'll go through it individually.
Yeah. Cybersecurity is a big deal, very important, and we take it very seriously. Well, this was an amazing hour spent with you gentlemen and Amy and learning so much from her. Um, as always, we are so thankful for all the clients and everyone that joined us today on the webinar and added to this discussion, especially that question that we just went through. We hope we answered your questions and are always available for any individual circumstances you want to discuss one-on-one. You can discuss it with your advisor, servicing advisor. So we'll be sending out an email with links directly to our calendars as a follow-up. In the meantime, we encourage you to do our website blog, sign up for the newsletter, and once you're signed up, you'll receive a copy of this webinar when available along with other articles that hit our blog. As always, I really want to thank each and every one of our clients for joining us and for being a part of Armstrong Dixon. You make our business possible, and we truly enjoy working with each and every one of you. Have a great start to 2026, and we'll see you next quarter. And Greg and Skylar, really appreciate your time again today, gentlemen.
Thank you, Nav.
Yep, and as a Baltimore sports fan, I can't wait till spring training.
That's right. There you go.
Thank you
Have a good
all.
one,
All right,
everyone.
see you.